The geopolitical tensions are rapidly changing. The Brent crude oil went from about $70 a barrel to 126 and then back down towards the high 80s. Last week things have changed dramatically and US and Iran conflict started again. If you only looked at where it started and where it ended, you would think almost nothing happened. But that's the most misleading interpretation of this entire conflict. Because underneath that round trip, the world quietly repriced itself and it never fully repriced back. So, today we are going to discuss what changed. I am Vikas, your host, and this is what changed from Wing, VYNG. So, let's first discuss today's scorecard. The headlines which we are hearing that the ceasefire ended the oil shock. Last week, until last week, it was true, but the reality, the ceasefire ended the panic, only the panic. It didn't reverse the reset of the oil, inflation, and interest rate expectation. All settled higher than where they began. So, the honest verdict this wasn't the spike and reversal, it was just a step change with only a partial refund. Let's walk through what actually happened and how it is going to shape the future, the economy, and other micro and macro level datas. For most of last year, the story was disinflation. Banks are about to cut the rates, prices were cooling, and the central banks were preparing to cut interest rates. The only real debate was when those cuts would begin. Then the war began in late February. Roughly 20% of the world's seaborne oil, along with significant share of global liquefied natural gas, moves through one narrow waterway between Iran and Oman. And that narrow waterway is called Strait of Hormuz. At its narrowest point, it's only about 21 miles wide. Really, it is just 21 miles wide. When that strait effectively closed, tanker traffic collapsed. Average daily tanker calls fell from roughly 51 to almost zero by beginning of the March. So the International Energy Agency described it as the largest supply disruption in the history of oil market. At its peak, the International Maritime Organization reported around 2,000 ships and 20,000 mariners stranded in the Gulf for a long period of time. And here is the part that matters. Well, the recovery is still incomplete. The latest data shows only about 8 tankers calls a day. And after this last week's attack of Iran on different countries' tankers, and also today they attacked on US bases on Bahrain. So still we don't have the correct figures how many tankers the and the people have stranded there, but however this was until last week figures. So the gasoline in parts of California rose above $6 a gallon before this ceasefire agreement. Jet fuel prices in North America nearly doubled, but the story didn't stop with oil. Refined products like gasoline, diesel, and jet fuel rose even faster than crude itself. And why this all happened? Because the bottleneck wasn't just producing oil, it was refining it and moving it. From there, the shock spread across the economy. Aluminium became more expensive because the smelting consumes enormous amount of energy. Fertilizer priced almost jumped as high as the supply were disrupted in the Gulf. That filtered into corn also, wheat also, and soybeans also, and eventually into plastics that we use day by day, daily basis, the building blocks of countless everyday products. Then came the ceasefire. It unfolded gradually through the spring and into June. And in one important respect, it worked. Well, the acute fear premium disappeared. Brent crude retreated from above $120 above and back towards the low 70s. Today, while I'm recording this, it is again rising and now it is near 80s. So the headlines about a stranded tanker faded, and uh, this is just an entry point. Now, the Strait of Hormuz never fully reopened after the ceasefire. Transit only partially recovered, and almost every downstream price settled above where it had started. So, why does a partial refund matter so much? Because of timing. This wasn't an energy shock hitting a healthy economy. It arrived while inflation had only been partially defeated. The Fed Reserve Jerome Powell was targeting inflation to 2%, and that changed the trajectory of global monetary policy. In the United States, needline inflation rose from 2.4% to 4.2% year over year. In May alone, energy accounted for more than 60% of the monthly increase. You could literally see the war reflected in inflation data, and that actually did. And that forced the Federal Reserve to change course. The new chair of Fed, Kevin Warsh, it's already highlighted and led his first meeting in June. The Fed removed its forward guidance, dropped its easing bias, and published noticeably more hawkish projections. Markets shifted from expecting one or two rate cuts to pricing a meaningful possibility of rate hikes instead. Monetary policy didn't simply pause, it reversed its direction. And it was not only the Fed, other central banks that had spent the previous year easing policy, cutting rates, they also responded to the energy shock. The European Central Bank and the Bank of Japan both raised their interest rates. Now, here's the encouraging part: markets absorbed the shock remarkably well. Equities stumbled, but they didn't break. Funding markets, the plumbing of the financial system remained calm. Currency markets pointed to an inflation shock, not a global growth collapse. Markets took the conflict seriously, but they didn't price it as the beginning of the financial crisis. Our conviction score for this story is 6 out of 10. And let me be clear about what that means. This isn't a buy or sell recommendation. However, it's our editorial assessment of how well the narrative it's over stands up to the evidence. The ceasefire was real, but now it's not real. The ceasefire has gone. The panic generally faded until last week, but again, the markets are pricing in the real panic. And today we are expecting the inflation data. So we will have a clear picture what Fed is going to deliver in their next FOMC meeting this month end. But the reset of the Strait of Hormuz, it never fully reversed because the Strait of Hormuz never fully reopened. The fragility didn't disappear, it simply became quieter. So here we need to see three things we are watching. The first, again, the Strait of Hormuz. Does tanker traffic continue recovering from this recent shock after this war already started? Again, it has started. So it matters a lot that the how this tanker traffic uh, pass through the Strait of Hormuz, all the Gulf countries, what their plan is. And it seems that this war has spread across the Gulf. The Saudi and Houthis are also, there is conflict, and US is also threatening Iran and by bombing and attacking their ports and other infrastructure. And Iran is also responding to this attack. At what level they will, um, reply, that we need to see. Second thing, that the relationship between oil prices and interest rates. Okay, so right now they are moving higher together. That's an inflation story. If oil rises while bond yields being falling, the market is shifting towards a growth scare instead. That's the more dangerous signal. And the third one, we need to see the mid-August nuclear deal deadlines, which was, I think, already it is scrapped, where ceasefire is ended. So third thing we need to watch, that how this war is going to end. Nobody has the clear picture. However, the market is on the cautious note, and they are not returning to the pre-war scenario. So the war pushed the world sharply higher, and the ceasefire brought us part of the way back. However, again, we are pulled back into the war, but part of the way is the entire story. The word repriced higher and stayed there. If you would like to explore the complete data behind today's episode, the complete research report is available at vyng.io with every figure fully sourced. We don't report everything, we report what changed. I'm Vikas. This is what changed from Wing. Clarity, not clutter.